Hey folks, David Frost, My Strategic Forecast. You're here for another episode of Common Sense Market Analysis. Today is Monday, May 14, 2018. You're looking at a daily chart of the SPY or SPDR, which is the proxy for the S&P 500. And we have a lot of stuff to go over today. I'm going to give you both the bullish case and the bearish case. I've got some supporting information. I'm going to tell you how to trade this market, or at least how various different traders would trade this tape right now, whether they were bullish or bearish. I'm going to go over various types of trades that you could take, and then I'm going to give you my thoughts on what I think is going to happen over the next several days. We are in options expiration week, so we have to expect the unexpected. We're likely to get a day or two where we have a wider ranging day than we did today, and we're likely to get a couple of fake outs along the way. That's not uncommon during options expiration week. So on the board today, you're looking at what I like to call a pseudo doji candle. So under normal conditions, a trader that was comfortable saying, I'm going to be short against today's high, can actually do so. But here's the rub, and here's where things get a little bit unclear. I'm going to give you my thoughts, and I'm going to tell you what I think can happen. One of the pitfalls of that is the next level above, and I raised this up a little bit. Last week I had this at 274.40, I believe. Now it's at 275. That's where I actually do believe the market can get to before this rally is over. I don't necessarily think that they have to close up there. I don't know that they will or they won't close up there, but I do think they can get up there. So here's the problem. You take a trade against today's high, and if the market goes up there, you get scared out of the trade, and if the market only stays up there for a short period of time, you really kind of got whipped out of the trade, and nobody wants that to happen. A secondary method to do that is to take a partial position where we are now, being able to add to the position up at 275, but the risk you're taking is if the market begins closing, if the SPDR begins closing above $275, it's going to go to 280, or at least make an attempt at 280, or maybe close to it. So that's the risk you run. The problem is a lot of traders I know like to play options. And the problem is if you're not right away with options, you end up being out of the money relatively quickly, and it's a diminishing return. Obviously, time is working against you when you're buying a put in a scenario like this. So that's the quandary. The quandary is that today's high is actually close to where I think the market can actually end up achieving, at least from an intraday perspective. Now let me tell you what I think is likely to happen over the next day or two. I think it's likely that the market comes back and checks in at this downsloping trend line. Remember, when we talk about support and resistance, we have to keep in mind that under normal conditions, the majority of the time, what is once resistance will become support on the way back down, and what is once support, if broken through, will become resistance on the way back up. So in this case, the downsloping trend line should provide a level of support on the way back down. Now, it's downsloping, so each and every day that number is going to change. Now, it doesn't have to stop on a dime intraday, but I would expect at least on a first test, if the market's going to test this downsloping trend line, I would expect on a first test, at least even if they pierce it through, spike it through intraday, I would expect us to close above that trend line, at least on the first hit. Keep in mind, you also have the 100 period moving average sloping across horizontally. That's somewhat of a safety net down below this downsloping trend line. So I do think we're going to test this downsloping trend line, but I also believe that we can still achieve $275 on the upside. Do we have to? No. Am I forecasting that we will? No. But I am saying the market can. One of the pieces of evidence that I have is I did take a look, at least on the SPDR, at the open interest puts and calls that expire this Friday. This is options expiration week for the monthly expiration of options, and this Friday, those options expire, the 18th, May 18th. I looked at the puts and I looked at the calls and I looked at where the majority of open interests were. And there's several strike prices along the way. Some important ones are 275. That's important on both the puts and the calls. 270 is important. 272 is important. On the upside, 279 and 280 is important. So there's some important numbers on the upside and important numbers on the downside. And the fact that this is options expiration week and the institutional options traders, their objective is to make money. So their objective is to make as many of these options expire worthless as possible. So they're going to try and whip out the individual investor, the retail trader. They will likely take the market up. They will likely take the market down. In what order, we don't know. I wouldn't be surprised to see them take the market down farther tomorrow, meaning Tuesday morning. However, I'm also not going to be surprised at some point this week to see the market up at $275. One of the things that certainly plays into the philosophy that the market is designed to trick, trap, and fool as many traders and investors as possible, and that would be one good way the market was able to do that during this week, is to go in both directions and really fool a lot of the market participants. So back to traders that are willing to take a position based on a doji candle against today's high. It's a reasonable risk reward, but you understand that right above is another resistance point at $275. All right, let's move on. And in fact, before we move on to the other markets, let me go over to another time frame and we'll just discuss various intraday time frames to see if we can gain any further evidence of what to expect. The 10-minute chart, you can see where we traded in a relatively narrow range today. We basically just went kind of sideways to lower all day. In the big scheme of things, that's more of a bullish consolidation pattern than it is any bearish behavior. And by the way, I also want to make mention, I'm going to go back to the daily chart for a second. I want to make mention of the volume. The volume today was less than 55 million shares. The average 90-day volume is 95 million shares in the spider. So we had very light volume. Light volume will tend to favor the upside of the markets. The path of least resistance is to the upside. Most of you have heard the old adage, never short a dull market. So I'm always weary about a market that's headed lower on the lack of volume. Not that we were headed lower today. We basically just did a nothing day. The S&P cash index was up just over 2 points today, so that's more of a rounding error. The Dow was up 68 points. The Nasdaq was closer to the flat line, up about 8 points. These are rounding errors, so the market really didn't go anywhere today, but the volume was light. Until and unless we see a significant pickup in volume, we're not going to expect any significant downside on this market. So back to the 10-minute chart. So this is really just evidence of a pullback or a bullish consolidation pattern. We had a gap, an opening gap from early this morning. You see here's the close on the 11th. Here's the open today, the 940 candle. The market filled the open gap, and that was basically all it did on the downside today. When we go up to the hourly chart, what do we see? The hourly chart came into the 20-hour, 20-period moving average, bounced off that. It's a bullish pullback pattern. There's really no evidence of a lot of further downside activity, although I do think the market can come in and test this downsloping trend line. But today, it was just a pullback. What if we go to a 2-hour chart, a 180-minute chart? So we did have a doji candle on the 180-minute chart, so that's interesting. That's a sign or a signal of a trend change. These are things that are discussed in the course at lazyemintrader.com. These are important at certain areas on charts. They're important after certain moves that a market will make. I'm not going to get into the details. All that's obviously discussed in the course. But what this tells us is that we shouldn't be surprised to see a short-term trend change, at least based on the 180-minute chart. But what the market is really doing on this particular chart is it's just trending sideways to lower. That's not necessarily bearish. It's more bullish than bearish. How about the 240-minute chart? So the market found a high, it started pulling back. It looks very similar to the 180-minute chart, just one less candle. It's just so far going sideways, but there's not a lot of evidence to be had on the 240, similar to the daily. The daily, we just put in what I like to call a pseudo doji. The 240-minute, we didn't put anything like that in. We have no bona fide reversal at hand because we don't have the volume. So while the pseudo doji may provide some kind of a trend change for the market, we don't have evidence of a significant trend change because we don't have the accompanying volume. That's why traders on the short side really do need to be careful. Without accompanying volume, it's very unlikely the market has a lot of downside in the cards until the volume shows up in the market. Now the IWM looks on the daily chart like a reversal. Again, we lack the volume. We have less than 15 million shares traded against an average 90-day volume of 21 million shares. I'm not going to call this a reversal. What I'm going to chalk this up to is we stalled out around the former highs in the IWM. It's not to say we can't continue higher. It can. What happens if the market went sideways for a little while longer, a few more days even? Would that be setting the IWM for another push higher? Would it be setting up the IWM, building energy to be released to the upside? Sure, that's certainly possible. We just don't have evidence one way or the other just yet. We need more time on the clock. When I take the IWM down to a 60-minute chart, what I do see here is that the market is beginning to consolidate underneath the 20-period moving average. If we continue to consolidate underneath the 20-period moving average, do you think the IWM is going to release some of that energy to the downside, maybe come into the 50, maybe slightly lower? This is on a short-term basis. This is hour by hour, but it's certainly possible based on the short term, meaning leading into trading on Tuesday, the IWM could be setting up for further downside activity. That does support the case if the SPY is going to come down and backtest the downsloping trend line that we just discussed before. How about the VIX? We've been discussing the VIX of late. The VIX is bearish. The VIX had an update today, up 2%, 28 cents. We're not going to make a whole big deal out of 28 cents one way or the other. I find it interesting that the VIX was up and the SPDR was up, or the SPX, the cash S&P index, was up slightly. The Dow was up. The NASDAQ was up. So these markets were not down, yet the VIX was up anyway. I think it's a sign or a signal, but I don't think it's an end-all be-all just yet. We're not going to really make a whole big case out of the VIX being up 28 cents. But it's of note. It's a puzzle piece that I'm putting on the table. I want to know about it. I'm tracking it, obviously. My ideal scenario is for the VIX to have another spike lower, potentially all the way down to the 1150 area. That's an area I would be interested in picking up the VIX. How do you play the VIX? There are several ways. Being short the market is very similar to being long the VIX. But if you wanted to play the VIX directly, if it should get to 1150, as I plan to do if it does get there, there are several different vehicles you can do it in. You can buy call options on the VIX itself. You can buy the exchange-traded products that are long the VIX, VXX, and then there are others that are leveraged products 2 and 3 times the VIX. Those products you need to be careful about, especially the ones that track or so-called track the VIX. They have in the past run into problems, even just as recently as a few months ago, and they're really meant to be intraday trades. The problems ran into were the traders that were holding them overnight. One of them collapsed. I forgot the symbol off the top of my head. I'm sure somebody out there knows it. Traders that want to participate in these exchange-traded products just need to understand and be aware of the risks associated with those products. It is a derivative of a derivative. And I can even make a case that it takes out one step farther, a derivative of a derivative of a derivative. So if the VIX is tracking volatility, the VIX itself is a derivative. If these exchange-traded products that track the VIX, they become a derivative of a derivative. And where I make the case that you can take it one step farther is volatility is tracking the movement of the market itself up or down. If the market moves up, the implied volatility gets sucked out of the market, so the VIX goes down, and vice versa. If the stock market comes down, the VIX goes up. We can argue about which one goes first. It doesn't really matter. The point is that playing those exchange-traded products, a derivative of a derivative, even of another derivative, you have to be careful. They're only guaranteed, and they're not guaranteed at all, but they're only as good as the issuer's solvency is at the time. They're a note on the issuer. It's like buying a bond backed by the issuer of that exchange-traded product. So traders just need to understand and do their homework, be aware. Looking over at the transportation average, the Dow Jones Transports, is my second favorite market leading indicator. And by the way, I need to do my intermission because I want to thank everybody for the continued participation and comments making underneath these videos. You're making them beneficial for all those traders and investors out there who are trying to learn. The more the community grows, the more we all benefit. It's a pay it forward scenario. I'm paying it forward by doing the videos. Please pay it forward by liking the videos, commenting on the videos, and sharing the videos with those you think can benefit from this information. So looking at the transports, we had a down day in the transports. So my second favorite market leading indicator was down. My first favorite market leading indicator, the IWM, was down. So the IWM leading the market in the downside, the transports leading the market on the downside. The market hasn't followed yet, but are these two indexes, are these two markets trying to tell us something? Are these two markets a canary in the coal mine? Remember, things can get disconnected for a day, for several days, but generally speaking, these markets will catch up to each other. But it's our job to analyze what we see. And if we find clues and evidence that the market is trying to tell us something that we need to interpret, it's our job to take those puzzle pieces, put them on the table, and see if, as we begin to assemble the pieces, can we get the picture that the market is trying to tell us. On one hand, the transports are essentially, on the daily chart, at least in a short-term bullish position. We know that we're inside this channel that we talk about frequently, the bottom of the channel, the top of the channel. We're finding resistance at the top of the channel, but we are above all the moving averages. So if the transports decide to move sideways for a while, they could be building energy for another push higher. Could the transports go down toward the bottom portion of the channel? Of course they could. We just need to be aware of where we are. The risk in the transports is if a trader was short the transports against the high of the channel, okay, the risk is breaking out above. But we know that if we begin breaking out above and closing above these highs, and we would get more refined. In other words, we would say if we begin closing above, for example, the high right here of 10,838 and change, if we begin closing daily above that high, we know the market is likely breaking out of the top end of the channel. But in a case like this, and this is just a lesson in the chart that looks like this, it's not necessarily a lesson in the transports, it's a lesson in a chart that's setting up as the transports are setting up right now. You could be short the transports against that high we just mentioned, 10,838 and change. And in terms of where the transports are and the price of this index, we're relatively close to risk, meaning we know where we're wrong, and where wrong is not too far away and it's small and fast. Again, take that as a chart lesson, not necessarily a lesson in the transports themselves. Although in this case, obviously it applies to both. Looking over at the Qs for a second, we do see on the daily chart a doji candle. I still contend the Qs really are poised to fill the gap up here. It would almost be, well, did they fill it today? Uncharacteristic if they didn't fill that gap. Now, one could say they came very close, so it's kind of like close enough. The high today was 170.82. In my book, the gap is officially filled at 171.02. So 20 cents away is very close, but officially it's not filled. It is a doji candle. We'll see what happens going forward. Again, I wouldn't hang my hat. I'm not looking at the doji candle as a trend change. It's a potential signal of a trend change, but we don't have volume accompanying anything. So therefore, we don't necessarily love a short position in a light volume market. Be careful shorting a dull market, but it can be a signal of a trend change. So an aggressive trader who wanted to take a short position here can do so against today's high. A daily chart close against today's high is a position. It's close to risk. It's a reasonable position to take. Just keep in mind all the other things that I discussed as it relates to the spider chart. And if I think the spiders have one more spike higher due for them, it's not necessarily something that has to happen. I just think it's certainly a possibility. And if it does happen, I would think that a rising tide would lift all boats, and that would be an opportunity for the Qs to go fill that gap. So we could be classified a little bit as in no man's land right now in the Qs. But again, it's still a reasonable risk-reward trade, very close to risk against today's high. Keeping in mind, above all the moving averages are converging. We are a little bit far away from home base, and therefore it would be likely that the market would want to come back toward home base, go sideways, eat some time off the clock, let home base come up toward price. Something like that is certainly possible in the Qs. I know I'm giving you both sides of the market in this video, and I'm giving you a lot of information on both sides of the market, but keep in mind what I'm doing is I'm interpreting each chart as it is, but then I'm trying to tie it back together to make sure that we all have an understanding of what the possibilities are on both sides. Listen, sometimes the market makes it easy, and sometimes the market doesn't make it easy. Right now, I wouldn't classify this as easy. Looking over at the XBD or the broker-dealer index, can we get any clues over here? And the answer is we're above all the moving averages on the daily chart. We've put in 2 pseudo-doji candles, and now we had a down day, but it wasn't a tremendous down day. 1/3 of 1% isn't anything we can hang our hat on. So all we really have is the XBD going sideways for the last 3 or 4 sessions above the moving averages. That could be the XBD's way of going sideways, building some energy to get through the high that was resistance right here. So we have to look at it that way. If that's the case, the market can go sideways and make another push, release some energy to the upside, or we could certainly roll over from here and come back into the moving averages. Both scenarios are possible. We need to be aware of both. And frankly, I can't tell you which way it's going to go right now. It's in a bullish position above the moving averages. We're going sideways. That tells me the market is building energy to make a push higher, but that doesn't mean we can't come down into the moving averages. And also, if I move this over a little bit, you'll see here, the last green up candle had a low of 290 spot 26. We can come down to 290 spot 26, and this is short-term stuff. We can come down to 290.26. We can still be inside the last green up candle. We could still be making a bullish consolidation pattern. We can meet with or check in at the 20-period moving average all at the same time and not damage the fact that this market looks to be bullish right now on a short-term basis. We have to be aware of all the scenarios. The XLF, the other financial index we look at, this is the XLF, the Spider Financial Index, has some different components than the XBD does. And you can see here that on Friday, we spiked through the 100-period moving average and put in a pseudo-doji candle. All right, we know that. Today, we had a high around the 100-period moving average, and we pulled back a little bit, 3 cents. It's not enough to do anything. It's light volume, so it's basically just a sideways day. Is this pseudo-doji candle going to be meaningful? Is the market going to pull back more? Or is it just going to pull back to inside the last green or the bottom portion? Remember, markets like to come back and test former breakout, former breakdown areas, lows of break up candles, highs of breakdown candles. I'm not calling the last green up candle a breakup candle. I'm just saying that it's likely, because the market does it all the time, that if the market's going to come down a little bit further, meaning the XLF, we could come down and still find support at the bottom portion of the last green up candle. That comes in, for example, here at 27.96. And look where the 50-period moving average is, 27.94. So even if we came down a little bit, it doesn't necessarily mean this is extremely bearish right now. We're above all the moving averages except the 100. So we just have to be careful of where we are. We know we have a lot of overhead resistance. We have overhead resistance here, but the market could be going sideways, building energy to get through that overhead resistance. But then we have more overhead resistance at this gap. So even if we did have another push higher, how much higher are we going to go? I'm not sure. There's a lot higher prices in store for this market. But what I am saying is, looking at both sides, we can have higher prices in this market. We need to be aware of both sides of the market. Another leading market indicator is the SOX. It's a nice leading indicator of the technology sector. We have a nice tail candle. We have a nice tail, you can also call it a doji candle, in the SOX. Look where the next level of resistance was or is, right up in this area. So the market made a run for that today, came up short, reversed, and put in a tail candle. That's interesting in the SOX. Now, still finished up 1.26% today. So up $17 in the SOX today isn't a bad day, but we have to look at the picture as well as the numbers. So when I see this, I want to take a look at the exchange traded fund that tracks the SOX, which is the SMH. So when we look at the SMH, we obviously see the same picture. I'm looking for volume. What kind of volume? Because this is a relatively liquid ETF. Traded 6.5 million shares today. What's the average 90-day volume? 6.5 million shares. So we didn't get a great pickup in volume. We did get a pickup in volume. So there's something going on in the SOX. Can you be short against today's high in the SOX? Yes, you can. You can be short against today's high in the SMH. Any trader that would take a position with a chart that looks like this is trading against today's high on a closing basis. Look what you have above us, though. This is the same quandary you have in the SPY. Right above us, even if we did continue higher, you're likely to find more overhead resistance right where I drew this black line. So that's also interesting in and of itself. And what I will tell you is, sometimes when trying to take a trade, when trying to take a short in the market, like we may be trying to do right now, I know some of us are, I'm looking for a turn, I'm looking for a market turn for certain. Sometimes it takes more than one attempt. That's just the way it works sometimes. Sometimes you might take a short position, you might get stopped out, and you might get right back in same day, day later, 2 days later, because you get the signal. It's a false start. It happens. And what traders can't let happen is, if we take a position and we get stopped out, and the chart and the market still tells us a day or two later, for example, or at some point in the future, that it's still the right trade, we can't be scared away from taking the same trade for the same reasons, even if we got stopped out 1 or 2 times. It happens. It's part of the business of trading. A lot of times, a trader will lose confidence and don't take the trade the second time, even though he or she feels like it is the right trade. Unfortunately, we get gun shy because we just took a loss. It's fresh in our mind, and it prevents us from taking the trade, which was the right trade for the right reasons. We always have to keep in mind that when we take a trade, we take it because the trade setup is there. We're 100% sure the trade is going to work out, but we also have a complete understanding that not all trades work out 100% of the time, and that's where taking the trade a second or third time on a signal is okay. Remember, it's the market's job to trick, trap, and fool as many traders as possible. And if you get whipped out of a position and the market tells you it's the right trade further down the road, the traders that succeed are the ones that don't lose confidence in what the market is telling them. Down day in gold. I thought gold, and I still do think gold has an opportunity to get up to the 1330 area, the convergence of the 150 period moving averages. But today was a down day by about $7.50. You see this last green up candle? Remember what I said before? Maybe, just maybe, gold is coming down to test the lower portion of that green up candle. We did have some market symmetry develop. So we had some market symmetry develop from down here. We went sideways, and then we had another up move, and the market basically completed that symmetrical move. We traded up into the 20-period moving average, coming down a little bit. It's a tough trade. The market's really not giving conviction. It's not giving a clear signal one way or the other. I'm not convinced to take a trade in gold here on the long side. I'm not convinced to take it on the short side. What we do know is a very important level is 1309 spot 50. Closing below that level is not good for gold, certainly on a weekly chart closing basis. On a Friday close, we don't want to see it below 1309 spot 50 if we want to believe in the upside for gold. Crude oil continues to go higher. We were up another 47 cents today, up a little more than 0.5%. We did put in a pseudo doji candle the other day. We put in a down day, but you know what this market is doing? It's just letting the 20-period moving average come up to price. That's it. No more, no less. This is bullish. The moving averages are upsloping. That's bullish. The market is just eating some time off the clock, in my opinion, letting price and the 20-period moving average get closer. That's eating time off the clock. It's essentially resetting the market, building some energy for another push higher. My belief is to the $74, $75 a barrel area, maybe even slightly higher. When we get up into that hot zone, you remember the hot zone. The hot zone we will be looking for a signal of a trend change up in that zone when and if the crude oil market does get up there. And with that, folks, I'm going to give it a wrap here tonight. It's a long-winded video. My apologies. I'm David Frost, my strategic forecast. Thanks for tuning in for another episode of Common Sense Market Analysis.